Hey, everybody, welcome back. Another beautiful day in real estate. And today we've got a few things we're going to go over, and we're going to keep pushing the optimism into 2026 and why I think the market's shifting and why I think we're moving to a new boom. So let's pay attention, jump in. First and foremost, as always, we're going to talk about interest rates. Just so you guys know, my screen's off to my right. So I'm watching that and as I talk. 6.1% interest rate on the average conventional across the United States. That's getting better. I mean, look at here. It's moving downward. It's moving downward still. I mean, based off of where we were before when we were at 8%, and some people were getting quoted over 8% interest rates. I think I had someone close at 8.25 in 2024. Oof, it's been rough. But we're starting to come back down. We're going to be normalizing, I think, in the sixes for right now, which isn't great. It's not terrible. It's just neutral, right? It means that we're getting steady because they don't want to drop interest rates because there's uncertainty in the conflict in the Middle East, which we'll get into that in a second. But also, I don't think they're going to move rates as they're waiting for a new Fed president with new policies coming in. So Kevin Warsh is supposed to be inaugurated in May as long as everything goes smoothly. If it does, those of you that know him, those that you don't, he is pushing to bring interest rates down. He's also looking to revamp the Federal Reserve as a whole. So we could be in for an interesting choppy few months before things start to settle out again. I mean, anytime a new portion of power jumps in, right? A new person of interest jumps in, things get shifty, especially since the market's been so weird the last few years. They want something new. They don't want old because old wasn't working. So anyhow, we're jumping into the new year with or the new week with interest rates right around that six is still, that doesn't mean that's the interest rate you'll get. Again, this last week, I had somebody that was quoted 5.75. I mean, if you have good interest rate, or excuse me, if you have a good credit score, you've got some money down. I mean, there's opportunity to get in the fives again. I even know a program right now that a local lender is offering where they're in the 4.84% if they make under $102,000 in their house or in their current household. Lenders are running incentives out the wazoo. I just got off a meeting with another one, VA incentives. There's there's a lot of incentives to get people into a house because nobody's been buying. Keep in mind, 4.06 sales happened last year. Okay. Put that into perspective. In 1995, that's how many homes sold. But there was 70 million less people in the United States at that point. We walked through one of the worst years in real estate. It doesn't matter that the numbers were the same. The people were significantly more, 70 million more people in the United States, and we did 4.06 million sales. People are waiting for a crash. You guys, we just walked through it. Last year was it was a tough year. We did very well. But this year, what did I read? I think there was I want to say there was like 5.7 million people can now afford houses this year that couldn't last year. Do with that information what you want. If you're a real estate agent, dude, get your shit together. It's going to be a good year. It's already becoming a good year. But we're going to jump in real quick. This Congress writes to Secretary Scott Bessent on indexing capital gains. This, in a whole lot of words, means one thing. They are trying to lift the barrier or at least the cap for how much you can make on your personal residence before you have to pay capital gains tax. Now, it says in the article that 1997, they came up with a rule that if you made $250,000 on your house or less, if you were a single person, or $500,000 or less, and you were a married couple, or married couples who filed jointly, you would not pay capital gains on your house. That's pretty awesome. You sell $250,000, you get $250,000. That's pretty sick. But that needs to be updated. And that's what this whole note is all about. That's what this whole letter is all about. They want to update that people are taking a lot of this equity into their retirement, and you shouldn't be taxed. The argument is you shouldn't be taxed for living in a house, right? You shouldn't be taxed for just living in a house for 25 years and making money on it. So I think we're going to see something like this. We have to. I mean, it right now that $500,000 from 1997 to now is like over $1 million if you put values side by side. If you're in California and you're selling your house, you bought a house in 1997, you're walking away with a chunk. I know that. My one of our friends, their parents sold in California, was there for like 20 years. They walked away. They were pretty thrilled. And then they moved to North Dakota where everything was about a third of the price, and they bought a house cash and they live very, very comfortably. People want to be able to do that. People want to be able to take their money. They might want to move to Florida. They might want to move to Arizona. I don't know. Some people want to retire and get their shit together. And some people just got lucky and bought at the right time and 10 years ago, and boom, now they got a bunch of equity and they don't want to pay capital gains. I wouldn't either. I don't blame them. But the optimism of this article is right here. Homeowners depend on equity for retirement. By 2030, the figure could rise 56% from a month, and I'll clarify it, meaning that by 2035, by 2030, 56% of people are going to be making more than $250,000 on their house. And by 2035, nearly 70% of owners could exceed that cap of $250,000 in equity. What does that mean? If they're talking about this, I mean, granted, it's just predictive data, but it means one thing. Homes are going to gain in equity. That's just what it means. We're going to see equity gain over the next few years. I talked to somebody this last weekend. They waited a year and a half. I've been working with them for a year and a half. They waited to buy a house. I could tell they were nervous. We tried to dissect what the issue was, and it was just, no, it's not the right home, not the right home. But you know what it was? It truly was. They were waiting for a market crash. They were waiting to see housing markets crash. And we had the conversation this weekend. He said, well, 23, everybody told me houses were going to crash. 24. Now they said 25. He's like, now we're in 26 and they're shifting it to next year. He's like, and that's why I said, hey man, this is why it's so important to talk with me about these things and be upfront, because we don't see that. Like, people are pulling data out of the wing. Like, oh, we're seeing as many job losses in the financial sector as we did in 2008. Or, we're seeing, I don't know, highest unaffordability since 2008, et cetera. You guys, the base issue is not there as it was in 2008. They're not subprime mortgages. People are not getting houses they can't afford. If anything, people have more equity in their homes that they don't want to sell. The inventory is minuscule. In North Dakota, Bismarck, there's one market right now. I think it's like the 600, right around the 600. I don't remember exact number it was. There was like 10 houses. No, sorry. It was in Mandan, $450,000, which is the national average, by the way. $450,000 homes. There was 6 homes. People want to move, but if they don't have the capability to do so, they're not gonna. If they don't see or justify the move as worth it, then why would they jump into the market? Why would they change this, right? So this is important to pay attention to. 2008 had so many different factors. Yes, something could happen, but we already saw the worst part of the market, in my opinion. We saw 4 million sales in 1 year, the lowest it's been since 1995. And yet people still bought houses and sold houses and closed on houses every single day. So many realtors, I want to say, I think it was like 41% of realtors were leaving the market in 2025 or 2026. Realtors, you just lost 41% of your competition. I don't know what it is locally, but I know we lost quite a few in my spot as well. Because the market isn't the same anymore. It's not, and I'll say this every time, it's not put a sign in the front yard and disappear and sell a house 24 hours later. That's not how it works anymore. We're gearing up to list a listing that we had probably overpriced last year. Straightforward. It was overpriced a little bit, I think. At the time, the comps made it favorable. We sat down. We're listing it for $60,000 less this year because that's the market we're in. Don't get me wrong. It's not great, but it is what it is, right? However, we're putting $3,000 into that listing before it hits the market because we want to make sure that it sells because this person has a house picked out and they want to move. This is not, you have to be willing to invest time and money into these markets at this point to sell homes. I'm not saying that it's completely required, but it's pretty close to necessary at this point because you can do cheap photos, you can do whatever you want, one open house a weekend or one open house a month, and you can overprice it because your seller wants to overprice it. It doesn't mean you're going to sell it. It just doesn't. We're not in the market where people are going to overpay for houses anymore. The interest rates are too high for one. Two, some people might because there's inventory shortages, but even inventory is starting to spike up again. People aren't going to overpay for a house anymore because we're not 2% and 3% interest rates where they get a mortgage payment of $1,500 for a $500,000 house anymore. That's just not. I mean, I know that's a little wrong, but we're not getting that anymore, right? At $450,000 house, including PMI, property mortgage insurance, and the taxes for the local neighborhood, at 5.75% interest rate, it was like $3,600 a month. People are paying significantly more to own a house. And if you're not going to price a house, and like I told my seller when we sat down, I'm like, I can sit here and bullshit you and say, we're going to do open houses, we're going to do pictures, we're going to do video marketing, we're going to do all these things to sell your house. But ultimately, the reason your house sells is because of the way it's priced. You can market it, and maybe somebody's going to be on TikTok or YouTube or whatever you're posting on Instagram, Facebook, and they're going to be like, "That's the house for me," and they're going to come running and making an offer. But that's not exactly how the market works. It happens once in a blue moon. I mean, maybe in bigger markets, it's more, but here it doesn't. I'm not going to lie to my client and just say, "Hey, let's list this thing and waste $3,000 just to have it sit on the market." We need to sell it. And a lot of realtors need to get that through their heads that you have to be upfront and honest with your buyers or your sellers. I sat down, I talked to a for sale by owner yesterday that we were talking to. Even they're willing to pay a decent amount, but we wrote an offer based off of the comparables that we could find. The for sale by owner asked, "How did you get it?" "Well, the one down the street's over this much, and that was 3 years ago, so we think we're right around here." We wrote an offer for less than what they wanted it for. And they came back and they're like, "That seems fair," because we gave the data behind it. You don't just write offers as a buyer's agent and just hope that you're right. You have to do the work, right? Anyways, I know that this year is going to change a lot. And I think a lot of people just aren't prepared for it just yet. I think a lot of realtors are getting ready for it. I think a lot of realtors are preparing for it, but so many left the market. And there's a few of us out here that are really diving deep. I'm a new builder. I'm a new construction builder. I think 70% of my work is new construction at this point. I love new construction because the people I'm sitting down with, they're moving and I get to build exactly what they want. I eliminate the middleman. I don't even have to go show houses. I mean, maybe show you my product so you know what you're getting, right? But building is awesome, dude. If you're a realtor and you're not working with a builder, man, you know what your list of work to do is this week. Go meet with a builder. Go meet with a builder. If you have a production builder that does good work, sit down with them. Figure out a way to get a listing or two, understand their product, learn their product, and you can be unstoppable. We tripled our business last year in the lowest market in the ever. Like one of the lowest markets ever. We tripled our business because it's all about figuring out what you need, right? What you can do to offer value to people, whether it's a builder or a buyer or a seller. You have to be able to understand when you sit down and you say, "Hey, this is my value." And not to get on the last thing I'll touch on is when it comes down to your commissions. I had a realtor that I talked to last week. She's been in the industry 30 years. She's complaining about how she's not getting 3% or doesn't, she's starting to get into a situation where 3% is hard to come by because now people are realizing the amount of effort people are putting in to sell their homes in such a positive market since 2017, right? And now it's hard and people are tighter on their money. And they saw that all these half-assed agents did this work. When you sit down with somebody as a seller's agent or a buyer's agent, can you justify your commission? If you can't, you're not going to get the 3%. Or in some big markets, 2%, 2.5%, right? You're not going to get that because you can't justify the amount of work and the amount of value that you're putting in behind your clients. Me, I don't care. I'll sit down and tell you exactly how I feel about that. Here's what I can offer. Here's my value proposition. I know it's worth this. If you don't think so, fine. I lost a listing to an agent the other day. They text me and they're like, "Hey, nothing against you. We're just going to go with this agent who's offering to sell it for 1.5%. This house is under $400,000. And in my mind, I'm like, how are they going to do the photography, pay taxes, brokerage fees? They're going to do open houses too, and they're going to do videography for 1.5%. You're going to go negative." Some people are going to justify that. I get it. It is what it is. I just text back. I said, if you can get the full value of a realtor for 1.5%, jump on it. I'm not going to fight somebody over that. And neither should you. Learn how to provide your value. And if somebody doesn't see the value, then they're not worth working with. I mean, that's just how it is. We're struggling to find listings and buyers and sellers. And it seems like every time we get in front of somebody, we have to just run really fast to get that information in front of them. But you don't. You just have to understand the value proposition behind it. Anyways, let's dive into the last bit of talking for an article base, or I guess information base for today, and we'll have a great day. So I noticed this morning on a couple of things on X. I always scroll X after the gym just to kind of grab a little bit more information, but something strange. Energy's down, metals are up. Or excuse me, vice versa. Energy's up, metals are down, right? This is what war pricing looks like. And they're not wrong, right? Crude oil is above 100 in some cases. Natural gas is going up, and then you have gold and silver starting to peak down. Like they're not collapsing by any stretch of the means, but they are dropping, right? Gold or silver was at what? Like, I don't remember, like 115 2 weeks ago. And I was pretty jazzed. It's my long-term hold, so I'm not really losing sleep over it. But gold was what, 2,500 a year and a half ago. Platinum and copper, I don't really follow as much, but I mean, they're starting to come down. But the question is why, right? Why is this happening? Well, it's happening because when you have a conflict like this in the Middle East, and we've talked about this in a previous video, the conflict is going to affect how markets operate. Everything has a cause and an effect, right? Just like everything else. You ever heard of the butterfly effect? It's the same principle. When something happens here, it trickles and it ripples throughout, right? We're in a time of war, right? We have, to a certain extent, you have Russia saying that they're partnering with Iran and we're a solid partner. You got the United States pulling more allies this way, right? And everybody's saying, well, it could end or it could be World War III. Irrelevant at this point. What's happening is what we need to be paying attention to. We can't predict the future and we sure shit can't change the past. So what can we focus on right now? We can focus on trends. And the most recent trend, and I didn't jump too deep. I ran out a lot of time. I was running on minimal time today, but I want you to look at these for a second. This is March of 22. I'll zoom in here for a second. This is March 7th of 22. We peaked on oil. And then June 22, we peaked on oil, right? So in the trading world, we call this a double top. This is crude oil, okay? US dollar. And then it falls 41%, 47% all the way until March of 23. Here's what we need to be paying attention to. Now, I just pulled it in recent history because I wanted to kind of showcase what I'm talking about. But June 22, right? Remember, June of 22, interest rates started to fall all the way down until August 22nd when they bottomed at like, what was it? 2.5%. This is the treasury bond. So mind you, interest rates are probably going to be about 200 basis points. So you're going to be at about 4.5% interest rate, right? When oil prices go up, and this is just a very big grasp, okay? I wanted something very basic to talk about because there's a lot more factors that go into this. But when you're talking about something like this, especially when you're having an argument over natural resources, especially oil, right now the argument is in Iran they blocked off. I can't remember the trading funnel, but they blocked off a portion so oil can't pass through. So oil is naturally going to go up because again, supply and demand. Less supply, more demand, higher prices. Just simple economics, right? But they're going to do this and then they're going to drop the interest rates at a Fed level, which means treasury bonds are going to go down because more people are going to go put their money into something safe like bonds, right? Because that's how money flows into security. And then when the security runs into those bonds, interest rates are going to fall, mortgage rates will fall, which means more people are going to be able to buy a house, which means more people are going to jump into the market, right? If we're at 4.5% interest rate, even if you have a 2.5% interest rate, the lowest it got, I mean, maybe slightly lower. I think somebody said 2.25 is the lowest I've heard. But we go to 4.5 on a Federal, on a 10-year treasury bond. I'm just throwing numbers out there, but I'm just saying this is what we should be preparing for. 4.5, 200 basis points gap between that and the interest rate, right? Or 2.5 to 4.5. I lied. 2.5% on the treasury bond, 4.5 on a mortgage. People can buy more houses, okay? Plus, remember, we still have an inventory shortage. Again, builders. We're ramping up. I know every other builder around the United States is ramping up. But also, if they push that 50-year mortgage that everybody's been having a conversation about, that's been talking about, imagine the amount of buying power people are going to have. So people say this, and I agree, 50-year mortgage is not a great idea. But they say, okay, if you're buying a 30-year mortgage versus a 50-year, you're going to save about $200 on your payment. But think about this. Drop the interest rate from 6 to 4.5. I know what a quarter basis point drops at. I did numbers on a commercial property recently, and it made all the difference in the world to have a quarter basis point. Imagine 1.5%. People are going to have a lot more buying power. And the article we just talked about, where 25 and 35-year-old people, I think it said 5.5 million, are sitting in their parents' basement, living with their parents, wanting to jump into real estate. They're waiting. The people with the 2.5% interest rates over here are waiting to sell their house. This market is going to shift. And when it shifts, tons of you aren't going to be ill prepared. Real estate agents, buyers, sellers, you're waiting for that day that it changes rather than just looking in just calling somebody who knows what they're talking about and saying, hey, let's go through this. Let's figure this out. Let's figure out a plan. I want to move in 6 months. I want to move in a year. A good realtor is going to follow up. A good realtor is going to help you create the plan. A good realtor is going to take time out of their day to say, hey, let's figure out what the next steps are. I'm ready for this year. I've been preparing. I've been doing my studying. I've been doing my continued education. I've been ready for this. And that's why we started doing the videos and the podcast stuff. And I mean, I guess studio stuff, whatever you want to call it, because I know what's coming, and I want to be the one telling everybody, get your shit together. Let's go, dude. This is time. So that's my information in a little longer video than usual, but dude, let's do this. Let's turn and burn. Let's make some money together. I hope y'all have a good day, and we'll see you soon.